Hey, this is Yossi. I run a small investment firm that specializes in REIT investing, and in today's video I'm going to do two things. Firstly, I'm going to explain why I think that REITs are the ultimate investment to achieve financial freedom and retire early, also known as FIRE. And then secondly, I'm going to highlight 5 of the best REITs to achieve that today. So why are REITs the ultimate FIRE investment? And it comes down to the fact that REITs combine the best of both worlds, of real estate and stocks. Everybody knows that real estate is a great investment if your goal is to achieve financial freedom and retire early. And that's because it pays significant monthly rental income, it enjoys long-term capital appreciation, you can leverage your money, you get tax benefit, and it's a great inflation hedge as well. But real estate also has many downsides, and firstly, it's not liquid. It's difficult to diversify, so you end up being highly concentrated on just one or a few properties and tenants. And thirdly, and perhaps most importantly, it requires a lot of work. And so I think that a lot of investors often are lying to themselves when they think that they're buying real estate to earn passive income, when in reality it can be very work intensive. And so that's where REITs come in. They combine the benefits of real estate with those of stocks. And so this means that you enjoy all the benefits of real estate, including the rental income, the long-term appreciation, leverage, tax benefits, inflation protection. However, it's also now liquid, well diversified, and you enjoy professional management who handle everything for you in a very cost-efficient way. So cost-efficient, in fact, that studies show that REITs are more rewarding than private real estate in most cases. There's been many studies on this topic, and in most of them, they show that REITs outperform by 2 to 4% per year on average, depending on the real estate strategy. And this is mainly because REITs are so cost-efficient. They typically manage hundreds of millions or even billions worth of properties, and so naturally, it leads to a lot of economies of scale in the management cost, but also in other cost categories, including brokerage, property management, maintenance, and everything else. Real estate is a low margin business, and therefore it's not surprising that these economies of scale would lead to stronger performance over time. And the best of all is that today REITs are priced at historically low valuations. Last seen during the great financial crisis, they've gone through a 3-year-long bear market, and now many of them are trading at 20, 30, or even 40% discount relative to the value of the real estate they own. As a result of that, their dividend yields have expanded to historically high levels. You have a lot of high quality REITs offering up to 8, 9, 10, or even 12% dividend yields. And so if you want to achieve financial freedom and retire early, I think that REITs are a great place right now because, again, they combine the best of both worlds of stocks and real estate, and they are heavily discounted, allowing you to earn significant passive income. And so in what follows now, I'm going to highlight 5 REITs that offer a blended average dividend yield of 8.7%, meaning that with an investment of just about $600,000, you could earn about $50,000 of passive annual income from your REIT portfolio. And I realize that some of you may think that $50K per year is not enough to retire these days, and I hear you, but you can adjust that to your lifestyle. You double it, 1.2 million, you could earn about $100K a year passively from this REIT portfolio, plus some potential growth and long-term capital appreciation from it. And so again, obviously there are risks as well, but I'm going to discuss those next. I think this is why REITs are today the ultimate FIRE investment. So what's the first REIT I'm going to discuss? And its name is NewLake Capital Partners. This REIT is today offering an 11.6% dividend yield. It's one of just a few REITs that focus on cannabis cultivation facilities. This is a riskier property sector that typically trades at higher cap rates, and this explains why the dividend yield of the REIT is so high. However, the REIT has done a great job at mitigating the risks, and there are many ways it has done so. The first one is that it's focusing on properties that are located in limited license jurisdictions, and this greatly limits risks because the demand for cannabis is rising, but the supply of these properties is limited by their licenses. And therefore, even if it goes through occasional lease defaults, it should be in a strong position to release these properties as long as the demand for cannabis is growing. The second way how it mitigates risks is that it's focusing on stronger and larger operators and signing landlord-friendly leases with them, with very long lease terms of over 10 years in most cases, with annual rent escalations of 2.6%. This provides some buffer in case it experiences some lease defaults in other parts of its portfolio, as the rents of the other leases will grow. And then finally, the third way how this REIT mitigates risks is that it has no debt. It's one of the few REIT that has no debt. In fact, it's significantly net cash positive. And so even if it went through occasional setbacks, as are common in this business, it's in a very good position to then release the properties. It's not pressed by time because it has no debt on its balance sheet. In fact, it has a significant credit facility with a lot of untapped capacity. And so it's in a really good position to handle whatever setbacks it will occasionally face. And looking at the track record of the company, they've done really well. They've managed to hike their dividend every year. In fact, sometimes several times in 1 year. And today their dividend payout ratio is at the low end of their targeted rate of 80 to 90%. I recently got to talk to the CEO of the company. We posted an exclusive interview at High Landlord. By the way, you can read it with our 2-week free trial if you're interested. It will be the first link in the description of this video. But what he was telling me is that they are confident that they will keep on growing. They don't try to hide that. Obviously, they'll have occasional setbacks, just like they've had in the past. But this hasn't prevented them from growing their dividend in the past, and they think that they will be able to keep growing it in the future. And despite that, they're offering an 11.6% dividend yield, which makes it very attractive in my opinion. The second REIT I'm now going to discuss is called Easterly Government Properties, ticker symbol TEA. Its dividend yield is currently nearly 8%. And this is the only REIT that focuses on specialty mission critical government properties. Things like VA outpatient facilities or courthouses, FBI field offices. And so what's very attractive here is that the government is your tenant, and DEA has very long leases with these government agencies. Its average remaining lease term is about 10 years. These tenants have never missed a rent payment. Because of that, its rental income is very conservative. However, despite that, this DEA recently decided to cut its dividend in order to retain more cash flow, to reinvest in growth and deleverage its balance sheet a bit. The market didn't like that. It's quite common for REIT investors to sell REITs whenever they cut their dividend, and so this caused its share price to crash recently. And as a result, now I think it's very attractive because valuation is very low. Even post-dividend cut, the dividend yield is nearly 8%, despite now retaining about 40% of their cash flow for future growth. Again, I recently got to talk to the CEO. We have, again, an exclusive interview at High Yield Landlord. You can also read it with the 2-week free trial. What he's telling us is that they expect to grow the FFO per share by 2 to 3% annually going forward by being able to reinvest some of this retained cash flow. 2 to 3% annual growth may not seem like much to a lot of you, but again, keep in mind that you're talking here about a REIT with highly stable cash flow that's already yielding about 8%. And so you don't need more growth than that to achieve double-digit total returns. If eventually REIT valuations recover, this REIT could also jump a lot higher, which would then allow it to also accelerate its growth by raising capital in the equity market and reinvesting it at a positive spread. But as long as the equity market is close to them because their valuation is too low, they can still grow by about 2 to 3% by reinvesting in this retained cash flow. And so I think the risk reward is very attractive here, considering that its tenant has such a high credit that it's so resilient. Before I go into the third REIT, can you please do me a huge favor and click the like button, subscribe to your channel if you think that this content is valuable. Thanks so much in advance. The third REIT that I would include in this list is Armada Hoffler Properties, ticker symbol AHH. It's offering an 8.2% dividend yield right now. It's one of the few REITs that focus on mixed-use properties. So these properties will often combine many uses under one roof. They might have a retail component, a residential, and an office component all under one roof. And these are very desirable properties these days. They are typically in walkable locations with high barriers to entry. And people like to live in these properties because a lot is happening there. You can walk to your office, you have some retail, you have some shops downstairs. It's a nice place to live. These properties typically command quite significant rent premiums and consistently enjoy very high occupancy rates and trade at low cap rates. Despite that, Armada Hoffler is priced at this high dividend yield because just like Easterly Government Properties, it recently cut its dividend, which has hurt its market sentiment. A new CEO came in. He decided that he wanted to adjust the capital allocation policy to retain more cash flow, to grow, to be less dependent on the public capital market, which today is pricing its equity too low to raise capital. And so now it's retaining far more cash flow, about 30% of it. It's able to organically reinvest in its growth, and yet it's still offering an 8.2% dividend yield. And so that makes it very attractive in my opinion. I think that going forward, the dividend is going to grow steadily. They own very attractive properties that keep enjoying solid rent growth, and so that is why I'm investing in this REIT. Fourth REIT is Modiv Industrial, ticker symbol MDV. It's offering an 8.3% dividend yield. This is the only REIT that focuses exclusively on manufacturing net lease properties. And the thesis here is that these properties could grow in demand now as a result of some of the current administration's policies, such as tariffs, as they will incentivize incentivize companies to bring back larger portions of their manufacturing and supply chains to the US. And so we could see a boost in demand for the properties of Modiv Industrial. Despite that, it's today trading at a low valuation, offering a very high dividend yield. Its portfolio today enjoys an average remaining lease term of about 10 years. They enjoy contractual annual rent escalations about 2.5%. Add to that a few acquisitions, and the REIT could enjoy a steady low to mid single digit growth, and yet it's offering an 8.3% dividend yield, paid monthly, by the way, which is quite attractive to some investors. Payout ratio is a bit high, but still offered margin of safety at about 80%. I think that makes it quite attractive. Last REIT on my list today is Gladstone Land Series P preferred shares. They're offering a near 8% dividend yield. Farmland typically is a low yielding asset class because it's quite safe. Everybody needs to eat, whether we're in a recession or not. But despite that, the preferred shares of Gladstone are today offering a high yield because they are discounted. They are trading at a 20% discount to the net asset value. The dividend yield is nearly 8%. And look, I agree with the market that the common equity is quite risky because the REIT has quite a bit of leverage. But I think that the preferred equity is well protected here because it's senior to the common equity, and the common equity tranche is still quite big, offering a significant buffer for it. The preferred dividend is really well covered. The REIT's LTV is 36%, which is quite conservative for farmland. What's also attractive is that average remaining debt maturity is 8 years. It's actually longer than the maturities of its leases. And so I think that as its leases expire, it's going to be able to bump up rents before its debt maturities, which will bump up its interest expense. And so overall, I think the REIT will do just fine enough at least to pay the preferred dividend. And so considering that's offering an 8% dividend yield, I think it's very attractive today. And for this reason, we own it in our retirement portfolio at High Yield Landlord. So these were 5 REITs that I think could today help you achieve financial freedom and retire early. They're offering very high dividend yield, prospect for long-term capital appreciation, inflation protection, leverage, and tax benefits. Makes them very attractive, and this is purely passive because you have management teams handle all of it for you. You stay liquid, you're well diversified. But obviously every investment has risks as well, and NewLake Capital Partners, as an example, is more heavily at risk of seeing some lease defaults, as it has in the past. This is a riskier property sector. Easterly Government Properties has weaker rent escalations leases, so it's more exposed to the risk of accelerating inflation. Each risk has unique risks, and that is why you diversify. Here we discuss just 5 REITs, but ideally you perhaps would want to own a portfolio that's even better diversified with 15 to 25 REITs that invest in different property sectors. And so obviously, sometimes you'll have some risk factors play out, so one REIT will do poorly, but at the same time, some other REITs will do even better than expected. And with this diversification, you'll be able to earn steady rental income via the dividend yield that will grow over time. And yet, despite that, you're able to get very attractive yields today. Finally, if you want to access my personal REIT portfolio, you can join us at High Yield Landlord for a 2-week free trial. As soon as you start your trial, we'll give you access to my entire real money portfolio, also all my trade alerts in real time, all my best research. You won't be charged anything in the first 14 days. You can cancel anytime, no questions asked. It will be the first link in the description of this video. Again, thank you very much for your support. If you could please click the like button, it helps me a lot. See you at my next one. Bye-bye.